Over the last decade, the financial landscape has experienced significant shifts, and as investors, there are valuable lessons we've learned during this period. In this video, we'll discuss 8 crucial insights that we've gained from investing in the past 10 years. Hopefully, these insights would help you invest and manage your money better. Slow and steady wins the race. You've probably heard this phrase from the popular kid story, The Tortoise and the Hare, a practical lesson in how to overcome the most difficult hurdles by taking little, steady strides. The same concepts are important lessons when investing. Being successful in investing, like accumulating wealth, does not happen overnight, as we've discovered over the last decade. Discipline, consistency, and time are required. We're talking about a long period of time. So if you want to be a successful investor, you must recognize that it will not happen in 1 or 2 years. You must consider the long term. For example, the S&P 500 is frequently regarded as the gold standard for yearly stock market returns, having returned roughly 10% each year before inflation for nearly a century. While not as striking as the instant millionaire success story, when combined with the power of compounding interest, slow and steady yields remarkable returns. Assume you put $6,000 in a well-diversified ETF at the age of 27 until you retire at the age of 65. With a $500 monthly contribution and a 9% annual return. You would have deposited just over $200,000 in total contributions, but you will have made almost $2.5 million in total by the time you retire. As you can see, the slow and steady approach is appealing, and even though it's not the kind of story that'll make the headlines, it's the strategy that most of us should use without relying on luck. Out of sight, out of mind. Consider how many times people plan to save and invest a portion of their next paycheck. When payday arrives, the money is gone. Or when they promise themselves that they'll save and invest after they've finished their food shopping and paying their bills. However, they soon find that there is little to no money left to invest. The second thing we've learned about investing in the last decade is that to have the best shot at growing wealth, you must prioritize yourself. Instead of giving everyone else money before taking care of you, pay yourself first. One method is to automate your saving and investing. Set certain amounts to be automatically withdrawn from your paycheck and deposited into your accounts. Think about it. If you don't see the money, you won't even consider spending it, right? You don't even have it. You are more likely to save and invest successfully and to keep to your investing goals than those who try to do it manually, according to the National Endowment for Financial Education. In addition to ensuring that your money is saved and correctly invested before you have the opportunity to spend it, automating your investment helps you stay on track even when you forget entirely. We're humans, we forget things. So why not automate as many tasks as possible to save up as much time as we can? Be wary of the hype. Did you know there was so much excitement around the dot-com bubble in the early 2000s that many people invested in speculative stocks, hoping to get rich quickly, only to have their financial lives lying in ruin when the bubble finally burst? We've learned throughout the years that it can be difficult to determine whether an investment has any real worth beyond the hype. Dazzling advertisements and frenzied enthusiasm from promoters and the media don't help either. We've read articles in the financial media about the next big thing and how those golden picks can convert anyone into a millionaire in 2 weeks. However, you should be careful not to get caught up in the short-term bustle. Don't let the market ruin your investment plans. This is the third lesson we've learned. Investors who blindly follow financial media are more likely to lose money over time than those who do not. People who follow the media are more prone to buy into fads and trends and are more likely to panic sell when the market is down. We're not claiming that every hot stock is a bad investment or that the financial media is utterly inept. We're saying it's critical to do your homework and understand the risks involved. If you do, you will be more likely to make wise, informed investment decisions. Have money goals. To get to a destination, you need some kind of map. That's why it's important to take an honest look at your complete financial picture and set money goals before making any investment decisions. It will help you make smarter selections and avoid the hype. Also, if you know why you're investing, creating a personal financial plan becomes easier. People who don't know what they're investing for, on the other hand, are more prone to settle with whatever is offered to them. What do you want to achieve with your money? Why are you making this investment? What comes first? Retirement, housing, or childcare? Assume you wish to retire at 65 with $1 million in savings. If you don't have a precise aim in mind, you could be tempted to invest in risky assets in the hopes of fast becoming wealthy. If you know you'll need $1 million in 30 years, you can make more investing decisions that align with the goal that will help you get there. When you know what you're aiming for, you're more likely to make sensible investment decisions and stick to your savings goal. Remember, a good goal should be specific, measurable, achievable, relevant, and time-bound. They should be smart. An emergency fund is crucial. This is one of the most important concepts we've embraced over the last 10 years. It's not fun or glamorous, but an emergency fund is vital, and it is one of the most crucial things you can do for your financial security. Of course, we all hope that our investments will be profitable, but what if life throws us a curveball? What happens next? What are your backup plans? Do you intend to use credit cards to meet your living expenses? Which, by the way, is a poor option. What if you don't have enough money to pay off your high-interest credit card debt afterwards? Or what if a short-term problem becomes a more long-term situation? An emergency fund of 3 to 6 months worth of living expenses is typically suggested, and it would safeguard you from going into much debt in the face of unexpected expenses. Understand your individual needs. I'm buying because Warren Buffett is buying is not a sound investment strategy. Blindly following the investment decisions of others is risky. Instead, figure out your specific reasons and requirements. Not everyone's financial situation is the same. We all have different risk tolerances, time horizons, and opportunities. To better understand how you want to invest, you need to understand all of these. For example, if you're someone who is highly averse to debt, then building a real estate empire might not be something that you want to do. Or if you know that you will be leaving the working world in a few short years, then you may find that you're less likely to invest in more aggressive options. If you're not quite sure how to determine your needs, here are a few questions to ask yourself. What are you investing for? How long will it be until you need the money? How much risk are you willing to take while making investments? And remember, you can always consult with a financial expert. Consistency is key. This is probably the most significant lesson we've learned in the last decade. Consistency is essential if you want to be successful in investing. Recognize that wealth building is a marathon, not a sprint. If you put one foot in front of the other, every day, month, and year, you'll see results. Consistent investing teaches us the power of commitment and patience. It entails having a strategy in place to invest on a regular basis, even when the market is down. Picture this: 2 investors, Alex and Jordan. Alex invests sporadically, trying to time the market, while Jordan diligently invests a fixed amount at regular intervals. Over time, Alex's investments suffer from the pitfalls of market timing, while Jordan's consistent approach leads to stable growth. The key lesson? Consistency beats sporadic efforts. By investing regularly, Jordan took advantage of market ups and downs, a strategy known as dollar cost averaging. Consistent investing minimizes risks, reduces the impact of market volatility, and harnesses the magic of compounding. So, whether you're a seasoned investor or just starting, remember, the path to financial success is paved with consistency. Invest in yourself. In the world of investments, we often focus on stocks, real estate, and financial portfolios. But amidst the hustle for financial gain, we often overlook the most valuable investment of all, ourselves. While market trends and economic conditions are beyond our control, our skills, knowledge, and personal growth are assets we can continuously nurture. Just as compounding interest can multiply financial gains, the compounding effect of personal development can lead to extraordinary achievements. Investing in yourself isn't just about taking courses or attending workshops. It's about cultivating a mindset of continuous learning, adaptability, and resilience. By expanding your skill set, you increase your potential for career advancement and income growth. By prioritizing your mental and physical well-being, you enhance your ability to handle challenges and stress effectively. Incorporating self-investment into your life involves setting aside time for learning, reflection, and self-care. Whether it's mastering a new skill, improving your communication abilities, or simply dedicating time to a hobby you're passionate about, every step you take in investing in yourself pays invaluable dividends in the long run. In a world where change is constant and opportunities are abundant, these few lessons have been crucial for our investing knowledge, so we hope you learned something new. If you enjoyed this video, please like and subscribe to this channel and turn on the notification bell. Don't forget to share it with others, and we'd love to hear what lessons you've learned from investing. Thanks so much for watching. See you in the next one.